today's presentation is about quantifying sustainable finance, right? I think that's very important because the term sustainability is very abstract and it means 1,000 things to 1,000 people, right? For example, in my industry, we are an active portfolio manager, right? And I'm part of Metzler Asset Management, which is in itself part of Bankhaus Metzler. It's one of the oldest German private banks, family owned. So we have quite a tradition of around 350 years. And this gets reflected in every meeting, whenever we exchange thoughts. It's a very long-term oriented business model. It's the perfect base actually to think about sustainable investing, right? Maybe a little bit of background information so that you understand what that presentation will be all about. So my background is financial analyst, right? I started out as a company analyst with a big sell-side investment bank. I used to cover transportation and utility companies. So you essentially build financial models to figure out, what's the fair value of the share, and then recommend it to buy, hold, or sell. Then I progressed into the strategy department, and I covered German equity strategy, and then later on European equity strategy. So you are a sparrings partner in this role for your institutional clients to figure out how you should weight certain factors in your portfolio, like sectors or regions or risk premium tilts. And in the late stage of this role, I was responsible for the integration of ESG into corporate valuation frameworks, which is quite a tricky task because you need to figure out what are the transmission channels between sustainability issues and corporate valuation. And there are many different ways to evaluate a company. So, bringing all this together, that was quite an interesting task. And then finally, since 2019, I joined a former client of that bank, Metzler Asset Management, and I'm now responsible for the integration of ESG into portfolio management, so across all the asset classes, right? And in this role, we really handle a lot of data, because if you are an investment management platform and you have to come up with a framework that makes sense out of this data, your biggest challenge is really to convince your portfolio manager that there's something to it, right? It's becoming a standard anyway. We'll talk about that in a second. So everyone will have to deal with that type of information. People used to say that, sustainable investing is a constraint because it shrinks your investable universe. So it's becoming tougher and tougher to outperform your benchmark index, right? But that's not necessarily true. It's actually not a constraint. It's a focus that helps to improve your return potential of your fund and lower your risk potential. And the combination of these two things is very important to outperform your competitors. So as an analyst, and that's the last word, your highest good is credibility, right? Only if you are credible and you put forward a narrative that matters and is differentiated, then people will start to listen. Yeah, and then you can build a track record with that. So the agenda for today's presentation will focus on everything an active portfolio manager needs to deal with when they consider sustainability aspects, when picking stocks. So the first chapter is really important, of course, because you have to show that your potential of return increases by considering sustainability aspects. And then the second section is equally important because you have to manage the risk that comes with these tilts. And then we'll look into a case study to show you how we deal with a real life issue like climate change and climate neutrality and how you can implement this into a portfolio. And then at the very end, we will talk about how you manage the concentration risk that emerges on the back of these tilts. And that's what not too many people talk about. It's actually one of the most important aspects when it comes to portfolio construction, because many just integrate data and develop tilts and preferences on the back of this, but do not explain how this affects their portfolios. And we are already in a situation where many sustainability products and also the conventional products are heavily tilted towards a certain type of company profile. And that's a big risk. We had a similar example in the new market around the 2000s, right? Where people were somehow stuck and gravitated towards these new type of companies. But when they were all invested and realized that there's a re-evaluation taking place, they all wanted to escape, but couldn't go anywhere because there was no liquidity to trade. And that's why the market collapsed in the end. So in sustainable finance, we're seeing these risks already, right? And we need to do something as an active portfolio manager to balance that effect. I'll get to that at the end of the presentation. So think about an active portfolio manager, right? There's a client and they give us a benchmark, and we need to outperform this by, selecting certain securities and avoiding stocks that we think should underperform. The biggest challenge with sustainability is that you have a mismatch between short-term performance goals, right? Because every client wants to see a good performance, risk adjusted on a quarterly basis, right? And depending on the client, they're willing to give you some leeway, but at some point you need to be better than your peers. Otherwise, the assets will just go to your competitors. And sustainability topics are rather mid to long-term oriented. So how do you balance this and bring this together in a portfolio? Because in the short term, you need to create performance, but you also want to invest that sustainably. And that's the biggest challenge, really. So I brought you a little piece of merchandise here that we created to show how we integrate this. So what you see here is Rubik's Cube, right? Many of you might know this as the magic cube. You can play around and change the colors. And what I've tried to demonstrate with this is this can be a symbol for the world of portfolio management. Because essentially you have 3 different groups of portfolio managers, 3 different investment philosophies. It's in German, but I'll translate it. The biggest group out there is the ones that work with allocation through sectors or regions and countries. Why is this? Because I think it's fairly easy to understand. You know what a car manufacturer does. You know what a chemical company does. You know and understand what a bank does. And then you can build preference for certain business models and pick your stocks. So that's the biggest investment philosophy out there. Then the second biggest one, these are the quantitative oriented investors. And they prefer to invest through the lens of risk premiums, right? So there are certain evaluation factors that you can combine, which in itself then is a factor. So for example, value, right? Value strategies look for cheaply valued companies based on certain multiples that you can calculate. And then you figure out, is this an under or overvalued stock? And then you buy the company because you think it's undervalued, and there might be a re-rating, which leads to the outperformance. So that's the quantitative oriented version of investing. And then finally, the third layer, sustainability, right, which is a rather new phenomenon. You see more and more financial products come to the market. And these people, primarily focus on ESG or sustainability topics. And then later on, they think about the business model and maybe about quantitative elements. So when you integrate sustainability preference in an active portfolio, let's say you want to be climate neutral, right? And then you make a change to your portfolio. And what it does is you may be climate neutral, but you cause changes on all other investment layers. If you do this often enough, you will see that you end up in a very specific niche of the market. So in a nutshell, everyone is after the same type of stocks and neglects all the rest. And that's a big risk because you're then, in a niche of the market. And if the market goes the other way and you want to, escape from these stocks because they don't perform in a certain economic setting, then there's nothing to buy because there's no liquidity, right? And then there will be a collapse. So these concentration risks, that's what concerns us on a daily basis. So we need to make sure, when investing sustainably, we need to have a portfolio construction tool that balances these effects again. But I'll come to that later. So the question really is, how do we tie sustainability data and preferences to these other investment layers? Because in the end, if you talk to a CFO or a CEO of a company, you need to somehow talk in the same language, right? If you just tell the CFO you need to be climate neutral with your company, then this is very abstract and they don't have the data to understand, this is my CO2 footprint and I need to do this and that to become climate neutral at the end. So you need to tell them this is the amount of money you need to invest. That's what happens to your capex ratios, to your sales growth, to your costs, and then they will try to understand. Okay, so this is what I have to do when it comes to becoming climate neutral. So bringing all these worlds together is really the biggest challenge, because we need to convince the portfolio manager that in the end, because of investing sustainably, they can improve their risk return profile of the fund. So what I just explained in a symbolic way is how we approach this. It's a rather complicated slide. I don't want to go into the details, but essentially it means that we need to translate sustainability topics back and forth so that we truly understand what it means in terms of corporate valuation. But let's take a step back. So how does this market work and what actually matters? The biggest question still is for everyone, how do you define ESG? So environmental, social, and governance topics. What's sustainability? What's sustainable investing? And the answer to this is tricky, because if you ask 100 portfolio managers how they define all of this, you get as many replies. It's all about the data, to bring it into one sentence, and to find out who has the interpretive sovereignty, right? Who's pushing the narrative so that people think, this is the type of sustainability we should follow. And the key to this answer is to understand the ESG data vendors. So there are big companies out there who source and harvest all the information that companies report. They make their own assessments, their qualitative assessments, and then they put all of this into a score. So this is really, I guess, the most common way how people define ESG, right? By looking at these ratings. Now, it's not ideal. Many asset managers then put forward a different methodology because they say it's more effective to purchase all data from all these different vendors. And then they somehow readjust these ratings so that they produce some form of super score that, is the truth. So it might be an intellectual progression, but it's not the most powerful signal that you could get for portfolio construction. Why? Because in the end, you need to understand where the flow is going. So the capital flow. And only if you understand and anticipate this, you will understand where the performance will build so that you can position accordingly, right? So, and for that, you need to understand the historic development of the ESG data providers and who's going to succeed in that market, right? Not only with active mandates, but also with passive mandates. So they are quite essential. And then everything gets aligned around that, essentially. For example, companies on the right-hand side in the middle, they try to report whatever they can to look good. They get their orientation from the top right corner, which is mainly which is the corporate reporting dialogue. So a combination of different platforms who bring out, reporting standards that companies can then use to show in their sustainability reports what they're all about. And on top of that, you have the supranational organizations that's on top in the middle here, like the United Nations. They put out a lot of guidelines on values and norms, which then, the corporate reporting dialogue on the right-hand side will pick up, or the ESG data vendors will structure their rating methodology to make sense out of these guidelines. And then, of course, the regulator sits on top in the top left corner of this slide. They essentially watch the market and then try to step in whenever they think now we need some form of common sense, so that, for example, asset managers can't put products out which they call sustainable, but in fact they aren't. So you need some control there. And then on the left-hand side, and that's a very important element why we say that ratings are relevant for financial performance, the rating platforms. You might have come across the name Morningstar, a company that acquired one of the big ESG rating companies, which is called Sustainalytics. And they usually compare all the financial products in a certain segment based on risk-adjusted returns, right? So if you're a fund manager and you somehow create a performance over a period of 5 years, and then they measure this and compare it to your competitors, and then the asset owner, which is our client as an asset manager, they can look this up and, you know, compare products and then decide with which one they want to invest. And these rating platforms compare all financial products nowadays, also on the back of ESG ratings. So if you're a fund manager and you might have the same, you know, risk-adjusted return performance as your competitors, but your ESG rating is comparably worse, then you're running the risk to lose assets because the asset owner cares, right? And it's an easy way to put or frame sustainability into one metric that the asset owner then can use to compare financial products. So it's very powerful. And then, of course, you have the rest of the market players like stock exchanges. They create whole new segments. You have index providers. They provide indices on the back of which, you know, you have passive products. And then, of course, the investment banks, who also are to some extent responsible for lending to companies. So I think these are the dominant players. And you can see that, you know, every aspect of the market has to deal with sustainability, right? The regulator tells you to consider all of that. So it's becoming a standard. Where are we in this cycle? That's what we try to capture with the lower left chart here. So in terms of sustainably invested money around the globe across all asset classes, you can say that we are around 36%, right? So roughly 1/3 of all invested money is invested by considering sustainability aspects. It's not saying that this is the perfect approach, but at least a third of the money worldwide is invested this way. And we think it can go to 90+% in the next 10 years, right? Because regulators tell you to, because there's a fierce competition among asset managers, you know, to put out the most credible approach and to improve returns and lower risk. So there's a competition. And then, of course, the clients, the asset owners, they want this and really drive this development. And the important thing to understand here is that the part from today into the future, that's what's not priced in the market, right? Because money is invested in a different way, and then the preferences will change, and this will affect prices in the market. So how do people invest actually when it comes to sustainability in your portfolio? That's the chart you can see on the right-hand side. I'd say there are basically 7 different approaches that you could apply to consider all of these you know, aspects. By far, the most prominent one is the one you see on the right-hand side of that chart, and that's ESG integration. What does that mean? It means you look at data you purchase from third-party vendors. You figure out what's financially material, either for the corporate valuation or for the stock price. And then you build preferences on the back of that. Then the second most prominent thing is exclusion or negative lists. So that means your client, in our case, the asset owner, they tell us, you know, these are the type of business models we're not funding, like controversial weapons, alcohol, tobacco, things like that. So that's the type of stuff you need to exclude as an asset manager, right? It's not really our choice to not invest into these companies in most cases, but it's because the client really wants that. And then you need to exclude that. And then you have corporate engagement. So that means asset managers talk to companies and try to convince them that they need to change the business model to become more sustainable. It's not really a strategy for a portfolio construction, but everyone does that. So it's nothing that you can differentiate yourself with. And then you have different approaches. So the question really is, in 10 years from now, what will be the dominant approach? And I think there is a misconception today how relevant these topics are and what will be relevant in 10 years from now. So I think ESG integration, so looking at financially material topics and then build your preferences on the back of that, that will be by far the dominant approach. Everyone will make use of that because it's almost like a self-fulfilling prophecy, right? If there is a consensus around a certain way to approach ESG in a portfolio construction, and let's say that the ratings will become even more powerful than they are today, then you can anticipate that fund managers will prefer a certain type of company profile because it has a good ESG rating. So you buy the company today and then the flow will come your way, right? So that will drive the outperformance of the stock to some extent. So it's worth positioning for that and anticipating that. And then one thing that's really underrated today, many people talk about it, but it's very difficult to evaluate, is impact. So that's on the left-hand side. And it's quite fascinating to see that many people talk about impact. What's the impact of a company, from an economic or environmental or social point of view? It's very difficult to measure. The easiest way to do it is to look at the revenues a certain company has and then align them with sustainability goals, right? That relate to ecological or societal aspects. The most common way to do this is to look at the United Nations Sustainable Development Goals and then match the revenues to them. And companies with a high exposure, we can show you a chart later on, they outperform massively, not because the business models are necessarily better than others, but it's just because the flow is coming their way, right? And there are not too many companies that give you a very high exposure. So you're running the risk of overvaluation and overheating there, and we'll discuss that later. But think about, sustainable investing and what it should actually cause. Yeah, we all want to somehow improve the way we live and our living conditions without really bothering our planet too much, because we only have one for the foreseeable future. So in the end, I think ESG integration and sustainable investing, that will all vanish because it will become a standard. In the future, maybe in 10 years from now, the only thing that really matters is impact. A similar thing today with our conventional methods, how to evaluate a company, is whether you generate you generate a return with your company that exceeds your cost of capital, right? If you fund your business for, let's say, 5%, and you generate a return of 10%, then you made 5 percentage points return ahead of your cost of capital. So it's worth investing in your business, right? It's a very simple equation. And if you if you can't earn your cost of capital, then investors will slowly but surely divest your company and focus on other stocks, and you will go bust. In the future, I guess, the only thing that really matters, of course, you need to be profitable, but at the same time, you need to have a positive net impact on the environment, and that is on the ecological aspect and on the societal aspect. So if you can't show that you create a positive value, I think your business will not be funded anymore, at least not from asset managers. So maybe these companies will have to go private. Maybe some hedge funds or governments will still fund them, but it's not sustainable and they will struggle a lot. So I think that's what the future of sustainable finance will look like. Now, let's talk a bit about the two methods that we just discussed that I think are very relevant. And that means that most of the asset managers follow these types of methodologies one way or another. So that's exclusion and then the ESG integration. Let's start with the easy one, exclusion. There are two different methods how you could exclude stocks. or companies in general from your investable universe. The first one, I'll start with the chart on the right-hand side, because that's what everyone focuses on, right? Controversial product exposure. Many people exclude companies that have, revenue or production exposure to alcohol, tobacco, controversial weapons, and things like that. Maybe thermal coal as well, because it's a driver of climate change. And then maybe oil and gas as a sector in general. If you had excluded that, let's say for a period of the last 10 plus years, it didn't really go so well, right? It just really starts now that in a synchronized way, all of these exposures start to underperform because more and more fund managers exclude the same type of things. And that tells you that, there's a flow argument behind it. You might be very right to exclude, companies that have a certain controversial product exposure, but maybe it's a growth segment, right? And usually people want growth because it generates returns. Then you will underperform because you're not owning these stocks. But only if enough people really divest these companies. That's when, excluding controversial product exposure really works. And now, over the last 2 to 3 years, we're in such an economic setting. More and more people exclude these stocks from their portfolios, and you can see that all these companies start to underperform relative to a global equity benchmark. So it works. And there's one exception, and that's alcohol. Alcohol can be considered a controversial product exposure, but it's not considered controversial by many. And it's a market segment that's growing. And it gives you a very strong return. So it's tricky to handle. And it depends on your mandate, whether your client says you need to exclude that or not. Maybe in the future more will exclude that, but right now it doesn't look like that. On the left-hand side of that slide, we can also exclude companies that are conflicted with controversial business practices, right? You might not be exposed to, let's say, controversial weapons or any of these other themes, but you could violate certain norms and principles in the market, right? Either laws or, let's say, corporate governance principles, because you're conflicted with anti-competitive practices or corruption or any other of these business practices. And we can measure that and track portfolios that are involved in these type of practices. And this chart is very encouraging, because it tells you if you build a portfolio across any of the global regions that's based on these controversy scores that keep track of controversial behavior, then all these portfolios underperformed pretty consistently throughout the economic cycle, right? So if you had excluded these companies from your portfolio or your investable universe, that was a positive contribution and it worked. There's only one region where it has been neutral over the last years, and that's the emerging market region in purple here, but at least it didn't hurt your portfolio, right? And more investment managers follow this type of logic. And that's a big incentive for companies not to behave in a controversial way, right? Because you will be added to watch lists and people start to underweight or exclude companies that behave like that. And then, liquidity goes out of your stocks and bonds. They become more illiquid to trade. That means the corporate valuation multiples fall. And when they want to refinance their business operations through financial markets, that means it's becoming more expensive for them, right? And it's more difficult to improve your risk return profile. And then you will lose market share to your competitor. So companies are highly incentivized not to engage into controversial business practices. So that's a very easy way to think about sustainability in a portfolio construction context. Now let's move on to ESG integration. And this is just an example. And I think it's an example that many of you can follow without being too complicated. So let's say for a moment that ESG ratings are very powerful, and we want to find out, does it add value to your portfolio if you create a preference for the good rated ones and shy away from the bad rated ones? And this is what the left chart is all about. So in portfolio construction, we create long-short portfolios to test whether a differentiation for a certain factor adds value. So that means you look at an investable universe at any given point in time, and then you build groups, let's say of 5, so quintiles. Group 1, the upper 20%, this is the group with the best ESG rating. And then you go all the way down to group 5, that's the group, the lowest 20% with the worst ESG ratings. And then you play the good ones against the bad ones in 2 portfolios. And the relative line you see here in this chart, this is what happens when you differentiate on the back of ESG ratings. So you play the upper 20% against the lower 20%. And it's quite encouraging. If you look at the dark blue line, we're still in positive territory. If you base the analysis in 2007 at 0%, and then you go all the way to 2021. So it's a positive contribution, a positive return. But it's not stellar, right? So it essentially says if you prefer the good ones over the bad ones on the back of these ESG ratings, then it helped your risk-return profile of your fund. But there's a better way, and that's by looking at the change in these scores, which we call momentum, right? So you look at an ESG score or rating, and you measure the change over the last X months, say the last 12 months. And then you play the improvers against the ones who deteriorate. And that's the light blue line. And that works even better for 2 reasons. The outperformance is higher and it's more stable, right? 2 components that really matter. So in a comparison of risk return, so risk here is the volatility of your excess returns. So the smoother this profile, the better. Then you can say that it's a clear improvement. So you should rather focus on the ones that improve and then shy away from those who deteriorate, instead of focusing on the absolute rating. Now that's theory. What's the problem with that? Have a look at the right-hand side chart. Now that just recaps what I just said. The ESG momentum strategy on the left-hand side in a risk-return comparison. So that's the bar, the light blue bar, that gives you a much higher value, right? So have this in mind. So ESG momentum is superior to the ESG tilt. But what happens if you consider transaction costs, right? Which is something you have to pay as a portfolio manager. And we repeat the analysis. And we just assume that you can do a portfolio trade at any given point in time for 1 basis point, right? Which is an average and low cost. And have a look what it does to your performance lines. So your ESG tilt, which is the preference for the absolute rating, we're at 0%, right? So it didn't hurt your portfolio, but it really didn't help either, right? And the momentum, all of a sudden underperforms because the turnover in your strategy is so high. So it costs a lot to follow this strategy all the way through that it bites into your outperformance and it overcompensates this. So it's giving you a negative return. So that means in a portfolio, you should really stick to the ratings, the absolute ratings, because implementing the change on a constant basis isn't really economically helpful, right? So on the right-hand side chart, you can see just how many times you need to turn over your entire portfolio on a monthly basis for these 2 strategies. So focusing on the tilt on the right-hand side, so on average, that's a 6% turnover of your portfolio positions. It's still too high, but it's just a theoretical example, but it's all right. But momentum, really, you need to change your portfolio by 22% in terms of the positions you trade every month, right? That doesn't make a lot of sense. So that's why I think in future, people will continue to focus on the ESG rating because it's just more practical to implement. Now, if you did this, the effect isn't equally positive across all the regions. If you repeat this ESG tilt strategy, so you play the good ones against the bad ones, across the major economic regions in the equity world. That's the chart on the left-hand side. You can see that it consistently worked in Europe, right? Since we have these ratings since 2007 and have a pretty consistent methodology. So that's a very stable outperformance line. It's very impressive if you are an active fund manager. And I think, looking back, this will cause many more people to focus on the ESG rating because they can argue that, look, it worked, and hopefully it can continue to work, because the more people focus on this type of thing, the more powerful this differentiation becomes. But that differentiation didn't work that well for other markets up until recent, right? For the US, Japan, and emerging markets in aggregate, it only started to work since, let's say, 2017. And there is an overlapping story why that is. Because over the last 2 to 3 years, we had a lot of capital coming towards sustainability or ESG dubbed funds. And this flow really helped, to create the outperformance. So it's a demand-driven outperformance. The big question today is this still fundamentally right, or is it an overvaluation? And it's just a hype and it's a bubble, and we really need to be very cautious if we buy these type of companies. So if you think about how an index is constructed, you can deconstruct it if you have two components and you build a product out of that. So for an index level, it's essentially your valuation multiple, and then it's your fundamental EPS, so your earnings per share. If you combine this as a product, that gives you the index level. You can do the same thing for equities at the stock level. So for the European market, where it worked quite well, we try to decompose this performance into the valuation multiple and the EPS. So on the right-hand side of this slide, you can see the same analysis, but just focusing now on European equities. And every line is, again, a relative statement. So we play the good 20% against the lower 20% based on the ESG rating. So let's start with the fundamental story, the dark blue line. So you can see that it's upward trending, it's rather stable, and it means that the good ones, so the good 20%, outperformed the bad rated bucket, so that the EPS profile could improve sixfold or almost sevenfold since 2007 until today. So it's quite encouraging to see that it's fundamentally backed. But if you look at valuation, the light blue line, you can see that the good rated ones always somehow traded at a, let's say, on average 20-25% premium over the bad rated ones from 2007 all the way through 2017. So it was maybe slightly upward trending, but rather stable. And then there was a huge boost, and it relates back to the story I just mentioned that holds true for the global market. The huge inflow of money that was after these type of products, and it pushed the valuation premium from 20-25% north of 60%. Is that sustainable? Because in a way, this is what we want, right? We want to fund the good rated ones, or at least the ones where we think, this is a sustainable company, and we want to defund the ones that are not. The question is, is that type of premium sustainable over the course of time? And is it really driven by, all the companies in the market, or is it just a segment that's pushing this up? So now we bridge the gap to corporate valuation. And as I mentioned earlier, the heart of any valuation model is to answer the question, can you, generate a return that's above your cost of capital, right? Because if you can't, you just destroy economic value, and you shouldn't fund this type of business. So we repeat this exercise for, this aspect of corporate valuation. So for the cost of capital, which is the light blue line, and the dark blue line, your return on invested capital, right? So if you play the good ones against the bad ones, again, the light blue line, somewhat what we saw in the EPS line a slide earlier, the good ones really generate a higher return on their invested capital. right? At the same time, they can fund at increasingly attractive conditions. That's the light blue line. And if this is trending lower, then this means that if you're a good rated company, or let's say a sustainable company, you can fund at increasingly lower costs. And this is a huge competitive advantage against, the peers in your global sector. Because if that just continues over time, that means that you will be more and more profitable, and your peers can soon be out of competition, right? Because if you can fund your operation at a lower cost than your peers, more projects become profitable, you can grow more, you can gain market share, and essentially push your competitors out of the market over time. And then they will struggle a lot to fund their businesses and essentially go bust, and you dominate the market. And that's a huge, powerful effect. So we can show that because of the ESG integration, fund managers add to this phenomenon that sustainable companies, can outgrow the unsustainable ones. So I think it's quite effective. And if you look at the current state on the right-hand side of this slide, what we do here is we have, the ratings at the bottom, the x-axis. So from left, the good rated ones, the AAA notch, all the way through to the right, the CCC notch. So these are the laggards, the worst ESG rated ones. And the y-axis on the left-hand side gives you the cost of capital. So the light blue line from the chart on the left-hand side. And that's an interesting distribution, right? It's maybe what we expected intuitively. The ones with a terrible rating have to pay a much higher cost when they fund their operations. And the ones with the good ratings can fund at a much lower cost. And what will happen over the next years is that this curve, this relationship will steepen. So at the very back, and then it will drop at the very beginning. So with the good rated ones. And why is that? What we observe is when you're a fund manager, the very first thing you care about when it comes to sustainable finance is the tail risk, right? If you have a lot of CCC rated companies in your portfolio and something goes wrong, then your client will say, look, the rating told you so, why did you invest these companies? And then you try to argue that, it's a good business model and I believe in the management, but it's very tough to defend that stance. So people just go get rid of these companies, right? That's the first thing they do. And the capital that gets freed from this will be almost equally distributed among the rest of the universe. And that's why you don't see a huge ESG bubble at the front, the good rated ones. We should talk about a bubble in terms of the inverse, so the discount that's emerging at the tail of the universe when you look at it through the lens of ratings. And some topics are being invested with a strong focus, so we start to see that at the very front there's a bubble building, but just for certain stocks. We'll get to this later. But in a nutshell, you can say that this is what the regulator wants, right? And it works. It's almost like a self-fulfilling prophecy. And the key to this is to understand, what's the data behind it? How do people make use of that? And how will they, think about sustainable investing in 10 years from now so that you can somehow anticipate or front run this? Now let's look at the risk aspect. Okay, so we were able to show that, sustainable finance, as an example, helps to improve your return potential. But what about the risks that are building up? And this is really the part that not too many people talk about, because maybe there is an incentive issue, right? If you talk too much about risk and sustainable finance, it's very difficult for you as an asset manager to collect assets. But I think it's actually the other way around. The more you talk about the risks, the more you can differentiate from competitors, right? Because you're the only one who really points to that and can offer a solution how you should balance that. So to not end up in this new market type world where you're caught in a niche of the market, and if things go the other way, you won't be able to escape. So we want to not be in that corner. So let's start about thinking sustainability in corporate valuation terms and in risk premium terms. because we need to somehow find relationships that are stable over time, right? Sustainability as a definition changes, right? 10 years ago, people thought about sustainability differently than they do today. And in 10 years from now, that term or definition or interpretation will change as well. So to bridge the gap to corporate valuation and to sector allocation and risk premiums, we need to find stable relationships that hold true throughout the economic cycle. And I think the easiest way to translate sustainability to corporate valuation is risk. Everyone understands risk. And that's what sustainable finance is actually all about. It's preferring companies with a lower risk profile because they manage their sustainability issues better than others. And they can, create higher returns, and in the end, maybe have a more positive impact on the ecological environment or the societal environment. So I will not go into detail in terms of corporate valuation here, but the summary is that there are 3 elements where sustainable finance has the strongest effect on corporate valuation. So first of all, it's your risk perception. If you are, well managed and the management is aware of all these risks and the opportunities, then the investor will be very calm and have confidence in the management. So they have a mid to long-term view, and then they think the money is well invested with that type of company. And that's meaning less volatility for the stocks, right? So the better you feel about a company, the more sustainable it can manage its business model, the less volatile the share price developments will be, and the lower the risk profile will be. So that's something you prefer as a long-term oriented asset manager. And then, of course, you need to be profitable. Only if you are profitable, it makes sense to look at that company. And then there's a third element that goes against all of this, actually, and that's the tax rate. But it's not a huge effect, because if you are sustainable and very transparent, it's likely that your effective tax rate goes up, right? Because you will probably not try to find every niche in the regulatory framework to lower your tax rate. So in the end, you end up paying more. But I think the risk and the return aspect that you can improve, that's really overcompensating that effective tax rate effect. So if you manage your company in a very sustainable manner, you improve your returns, you're long-term oriented, and you lower your risk profile, what will that do to your investment profile? And that's why I like to think about this in risk premium terms. And just to repeat that, what's a risk premium? It's essentially the combination of corporate valuation factors that you can express in, let's say, a scale between 0 and 10, so you standardize it. Let's take the example of growth. So you can grow your revenues, your earnings per share, you maybe have a higher profitability rate, and so on and so forth. So you have, let's say, 3 to 5 factors that measure that. And then you bring this together into one factor that you deem profitable. If you expose your portfolio to it, then you will be compensated for some form of risk, and this positioning will create the outperformance. And there are certain risk premium forms that you could tie sustainability matters to. But essentially, there are 2 groups. The first group are fundamental risk premiums. So anything that relates to the financial KPIs from the business development, like growth, your dividend or your earnings per share and things like that. And then you have the price-based risk premiums. So anything that relates to the pricing of your securities as a company. So that could be value relating to valuation multiples, like the price to earnings ratio, the price to book ratio, or the price to cash flow ratio. You could measure volatility. That's a price-based risk premium. You could measure the beta of your stock. So, and that essentially means how strong the fluctuations are relative to the market when you relate it to the economic cycle. So these two groups. And if you look at sustainability preferences, and let's say ESG ratings will be dominant, right? And that's the market's preferred way to distinguish between a good and the bad rated one. And more people will focus on this differentiation. Then it will tilt your portfolio into a very certain way. And everyone does it the exact same way. So everyone will end up with company profiles that look like, growth. They grow stronger than the rest of the market or competitors in their given industry group. Companies that look like quality. So that means companies that are highly profitable, that are, fairly low leveraged and not excessively leveraged, so that it's difficult for them to repay the debt. And companies that have a low volatility profile. And that's a very conservative type of investment profile if you combine all of these. And what sustainable investors, through their preferences on the back of this ESG data, what they really get rid of is anything that looks cheap, so value. Well, value is somehow feels like it has a positive connotation, but it really just means that something's cheap, and then it all depends on your view whether you think the market has mispriced these stocks. But the sustainable investor really doesn't mind rich valuations. They rather see cheaply valued stocks in combination with a high dividend yield as a risk, because they think it's really unsustainable and that the company might not be able to, be able to pay this over time. And anything that's volatile and high beta, right? So you have two camps. What I'm trying to say is, if you try to be sustainable in your portfolio and you gravitate towards the very conservative type of business models, your portfolio structure will become defensive. And everyone does it the same way. So that's a fascinating observation not too many people talk about. So if you're a company and you have to think how to position yourself in the market, how to position your business model, then the conclusion should be as defensive and long-term oriented as possible, because that's what the sustainable investor prefers. And just remember the chart that we showed at the beginning of the presentation. If you look at the share of the money worldwide that's being invested under sustainability preferences, that's 1/3 today. If it goes to 90+%, you will understand that many more people would start to have the same preference and prefer the same type of investment profile. So that's a big incentive for a company to get away from everything that's cyclical and, change your portfolio as a company towards being a more conservatively oriented and long-term and growing business. And we can measure this, right? So it's not something that we think could happen. We already observe that this is how these type of preferences behave. On the left-hand side, that gives you a correlation between ESG ratings and various economic factors sorted for the economic cycle, rates, foreign exchange, and commodities. And if you compute these correlations almost in any given point in time over the last years, you end up with the same output. And that's a very defensive output. So just an example, the economic cycle on the left-hand side, if you have a negative correlation there and the purchasing managers index, the PMI, is a very prominent indicator to measure where you are in the economic cycle, then you get a negative correlation with ESG ratings. And that means if the economic cycle recovers and you're somehow in a boom period, if you prefer good ESG rated companies, you underperform. Right, so it's a defensive way to put your portfolio together. And the chart on the right-hand side proves that this has been very consistent over time. So here are two variables that we reflect against each other. On the left-hand side axis, that's the economic cycle, the global economic cycle. So we have an indicator for that. That's the light blue line, right? It moves up, it moves down. And especially during the recent COVID crisis in 2020, let's say early 2020, you had this huge shock, okay? So when the light blue line trends up, that's when your cycle recovers. And then on the right-hand side, inverted, that's the performance of your ESG leaders, so the good rated ones, relative to the market. And it's almost a perfectly matching combination, but in inverse terms, right? So that means if the economic cycle recovers and the light blue line trends up, then, because the scale is inverted, your focus on ESG leaders underperforms. And if the economic cycle weakens again, then you start to outperform. But on average, throughout the economic cycle, we can show that this preference generates a positive return, like I demonstrated earlier. But it's just to tell you, sustainable finance prefers defensive business models. The question is that something that can be sustainable? Because there's one observation that many people miss. And that's really a connection we can make with risk premiums. So have a look at the left-hand side chart. Again, we show correlations between ESG ratings and the different risk premiums that I mentioned earlier. So we can show how sustainable finance looks through the lens of a quantitative investor. And this relationship has been super stable for decades. So if you look at the fundamental section on the left-hand side of the left chart, you could see that there's a very high and positive correlation with quality, income, and growth, right? So very stable risk premiums. And there's a very negative correlation with values, everything that's cheap. And now you can backtrack this and you play quality against value, which is essentially your ESG trade in risk premium terms. And we go to the right-hand side chart and we try to find out what's driving, a preference for quality over a preference for value. And again, this is somehow also reflecting a preference for good ESG rated companies against the bad ones. So it's a proxy, if you want. And there's one economic variable that almost perfectly matches this since the mid-1990s, essentially since we have data on this. And this is economic uncertainty. So the chart on the right-hand side, on the left axis, gives you the performance relative of quality over value, right? So the ESG proxy, if you want. On the right-hand side, the economic indicator for policy uncertainty. What the chart tells you is that the more uncertain the economic environment becomes, the better quality performs against value. So you could argue that the ESG trade is nothing more than a risk premium trade. And that's because everyone's escaping risk in a world that is increasingly uncertain, right? Whenever this economic uncertainty indicator drops, so the light blue line goes lower, this is where quality underperforms and value outperforms. And also your ESG trade doesn't work anymore. But it has worked maybe since 2005, 6, 7, maybe since the financial crisis, because of the risk environment. So the question is, if you strip out all of this from the ESG trade, is there still an outperformance? And that's the big question. But you could say that a preference for sustainable companies with a certain risk premium profile, somehow worked. The question is, will it continue to work? And it really worked well during the time of the trade uncertainty between the US and China, because that was when economic uncertainty was at its high level. Everyone was escaping risk and gravitating towards the stable business models, the good ESG rated ones. And maybe that's a big explanation why the ESG trade actually worked, right? Not necessarily because the companies are sustainable or more sustainable than others, but because risk was priced in a very certain way. So that's a lot of theory and observations. Let's just, take a step back and breathe and try to summarize this in one slide. What is it actually that the sustainable investor prefers? Because in the end, it seems like it's companies, that profit from a strong market position, where you also have pricing power, where you have your stable cash flows, and you can, continue to grow organically and not necessarily inorganically with M&A. Actually, the sustainable investor prefers company profiles that grow organically rather than through high-risk M&A transactions. Why? Because if you purchase other companies, you also create a lot of goodwill on your balance sheet, right? Because the valuations somehow deviate from what the assets might be really worth. And over time, you need to essentially devaluate these type of positions on your balance sheet, and that's affecting your profit and loss statement. So, where you start with your revenues, then you have your costs, and then at the very end, you have your profitability line. And that creates volatility and uncertainty. And that's why sustainable investors, who really hate any time of uncertainty and volatility, that's why they rather stick to companies that grow organically, where these deviations are less likely than the ones you have with M&A transactions and when you grow inorganically. So in the end, I guess what people really avoid, to put it in a nutshell, is companies with a challenged business model, which you could also see reflected in low valuation multiples, which value as a risk premium captures, and to really struggle to fund their businesses, right? And the only reason why many investors maybe hold on to these companies is because they pay a huge dividend. So maybe the stock performance is rather flattish and maybe volatile, but at least they pay a high dividend, and that's what they are after. But it's not what the sustainable investor wants. The sustainable investor really prefers companies that grow instead of handing this money back to cash, back to shareholders, right? Because they really want stable growth and not just a challenged business model. And in a nutshell, I guess this is how you translate sustainability to return and to risk premiums in a portfolio context. And maybe in the interest of time, let's just go to the case study and have a look at a real life example, how you treat this type of data and how it affects your portfolio and how you can balance it. And I thought it's probably best to focus on the theme that's on everyone's mind. Well, first of all, climate change and the big movement in the asset management industry to create portfolios that are climate neutral. Now, what does that actually mean? If you go back to, well, the United Nations IPCC report, so the idea is to limit global warming to a certain extent. And the base for this is the pre-industrial revolution period between 1850 and 1900. So we really want to limit global warming relative to this period. And the Paris Agreement, which was a very important element in 2015, that's essentially a non-binding contract between 195 different countries worldwide, including the EU, counted as one, that you do whatever you can to limit global warming to about 1.5 degrees Celsius relative to that pre-industrial average. How do you do that? First of all, of course, the emissions a company produces. That's essentially the key to understand what your footprint is and how you can lower it. And then later on, we can also talk about climate mitigation, right? What can you do to lower it actively? So if you think about CO2 emissions, which is the biggest chunk of all emissions which companies produce, we try to explain that complex in the left-hand side chart. So CO2 emissions, are really the heart of all emissions of a company. And you can split them up in 3 different categories. So scope 1, that's the dark blue part here in the middle. That's what your company emits directly through your production facilities, through all your buildings. And that usually accounts for 15% of the overall chunk. Then you have scope 2, which are the CO2 emissions you inherit through your energy bill. You need energy to run your production facilities or your buildings. This energy is produced in a certain way depending on the mix, and CO2 emissions come with that. And you need to account for that as well. And then the biggest part, scope 3, which is by far the most difficult part to measure, that accounts for 80% of the entire CO2 emission block. These are all the emissions that emerge throughout your value chain in your upstream businesses and in your downstream businesses. So essentially, you're a company, you're producing goods. Upstream is everything you take into account, so your suppliers, things like that. And downstream is then everything you're doing to sell your products, maybe including business travel as well and things like that. And that's 80% of the story. So as a company, this is your CO2 footprint. And you could measure this relative to your revenues or any other metric, and then you arrive at an intensity. So your CO2 intensity could be your CO2 emissions over all these categories relative to your revenues. That's a very easy way to compare a footprint among companies. The tricky thing is, how do you, translate this to the warming potential of a company so that you understand by how much you should reduce your CO2 emissions to be in line with that Paris Agreement, and not to be, divested from investors because you have a very high warming potential, because you really want to be compliant with this trend as a company, because all the portfolio managers will try to bring their portfolios into a climate neutral position. So top down, economically, the right-hand side chart gives you how the world looks like today and how it could look like in the future. So the black line from 2000 until recent, this is the historic development of global CO2 emissions in gigatons. What you need to understand is that there's a certain CO2 budget worldwide. If you exceed this budget, so the concentration of CO2 in the atmosphere, it will almost be impossible to stay within a below 1.5 degrees or 2 degrees Celsius environment. And then it will be very difficult to reverse all of this. And if we did nothing, right, if climate change topics wouldn't matter, then we would follow the gray area, the dark gray area on top. So we would end up with an economic environment that is, 4+ degrees warmer on average than the pre-industrial average. And of course, the consequences are critical, right? There will be more extreme weathers, there will be droughts, there will be floodings, all these things that impact the way we live today. And this is what we try to prevent in a nutshell. So if you, take into account all the policies that policymakers publicly stated, you could end up in a world where we lie between 2.4 and 3.1 degrees Celsius above that pre-industrial average. It's still way too warm. So based on what everyone has said, that's way too warm, and we need to be much tougher on climate policy, with huge effects on companies because they have to adjust their business models, divest certain assets and invest heavily into certain other markets. And that's a huge transition. So capital markets are in the role to fund this transition. It's really difficult to find out what are the good and the bad ones, and it all depends on data. So the better the data, the better your informed investment decision. So climate policy will tighten considerably over the next couple of years. What does it mean for your portfolio? We can translate the CO2 budget of any region or government to sectors and then break it down to companies, so that in the end, you can translate your CO2 intensity into a warming potential number. And then on the right-hand side, you can measure that warming potential for any of your funds, right? If you look at an average equity index benchmark worldwide, say the MSCI All Country World Index, then you will see that the aggregated portfolio temperature of an equity market is about 3 degrees Celsius, still way too high. So there will be a strong rotation of capital over the next years, because we need to end up at 2 or 1.5. So how does it look like? So like I said, the average index temperature is still too high. We've done the exercise for the regional equity markets in the left-hand side chart. And so we broke up the markets into the Americas, Europe, and Asia Pacific. And I think that's quite an interesting finding, because if you follow the news flow worldwide, you could come to the conclusion that, yeah, maybe, the US is a strongly polluting economy, also China as well, because they account for the biggest chunk of the emissions. Europe, as a direct comparison, just accounts for 7% of global CO2 emissions, right? So rather low as a big economic region. But when you look at the equity world, it's actually the US that's leading here. That's because of the high weight of technology sectors in that market, which all have a very low warming potential number. And in itself, it's questionable, is it economically reasonable to optimize your portfolio just on the back of this warming potential number? We can discuss that in the Q&A maybe later on. So what do we observe? The right-hand side chart, maybe this could be one of the last before we go into Q&A, because it's already 11:30 and I'm curious about the questions you might have. What we already observe is a capital rotation out of the ones with a high warming potential into the companies with a low warming potential, because all the asset managers try to lower their aggregated warming potential. And that's perfectly working among large cap companies, where you also have a high weight of oil and gas and basic materials sectors, and that's the dark blue line. So this gives you the performance relative of two portfolios, portfolio A with the low warming potential numbers, and portfolio B with the high warming potential numbers. So again, maybe the good against the bad ones. And that capital rotation is powerful. It's not working really well in the small and mid-cap world. And there are several reasons for that. So there might be a lagging effect, but that's something you need to take into account when you structure your portfolio and you want to create outperformances over the next couple of years. So anticipating that capital rotation on the back of that warming potential number, that will be a very important factor. And again, we haven't really discussed revenue or cost or EPS effects. It's really coming from a top-down oriented investment philosophy, because it's super difficult to measure that at the stock level. And if you did that, you would never be able to finish your analysis, right? So you need to come up with a more digestible approach that you can then itself communicate to your clients, because usually they're less sophisticated than you are. And that's why I think many more people will follow these top-down approaches in the future. So finally, maybe let's go to the last slide and just talk about what are the points we could discuss. So first of all, thanks a lot to all of you for paying attention. In a nutshell, again, sustainability is a very abstract term. Like I said, if you ask 100 portfolio managers what it means, you likely get as many replies. But I think there is a consensus forming, and it all relates back to data and how people integrate sustainability aspects into portfolios. But again, there's a huge risk that everyone does it in the same way, and that could create concentration risks. So because people end up in the same niches of the market, but if for some reason, like I explained earlier, economic uncertainty drops and we're in a Goldilocks scenario where everything will be better and less risky, then all these tilts will underperform massively. And that could really put the whole trend of sustainable finance at question, right? Because if you can't generate an outperformance, your clients will probably say, look, this is probably not the best way to put together your portfolio. I really want to invest sustainable, but I want to have some decent returns. And you need to bring these two components together. Otherwise, you will be out of business as an asset manager. So in the end, I guess that's it in a nutshell. Translating sustainability to other investment philosophies, and especially into the language of a corporate management, like a CEO or a CFO, so that they understand what it means when you say investing in a sustainable way, how it affects their key financial metrics, like revenues, costs, EPS, dividends, balance sheet items. That's the best common ground to bring this topic forward and to make progress. It's developing, but I think it's encouraging to see that, you know, all of you have this, for example, as a mandatory element of your master's program. It wasn't like that 10 years ago. I, for example, you know, was really much focused on finance, on every aspect I could find. But over time, you realize that, you know, for finance to make sense, you need purpose, some form of purpose. And I think that's a great development that we see right now. So I encourage all of you now to come forward with your questions if you have any. If you don't, and if you're maybe shy, feel free to, you know, contact me maybe through my LinkedIn profile. Have a look at the research we put out. I think it's quite fascinating to write and publish about all of these things. And just, yeah, feel free to contact me anytime. Laura, back to you.